Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now last week I got on an international flight after what's been well over 2 years. The good news is that flights were not nearly as empty as I'd feared, but the recovery clearly has further to go. In Singapore, for example, Changi Airport passenger traffic bears out this story. December 2021 data shows an encouraging uptick, but the level remains very low compared to what pre-pandemic traffic looked like. I'll post that chart on LinkedIn later this week if you want to take a look. Now, what does not help an airline sector recovery is higher oil prices, and that's what I wanted to focus on today. WTI oil prices rose sharply last week to above $94 per barrel. Escalating fears of a war in Ukraine continue to be the major driver. Recall that Russia is one of the world's largest energy producers, and it's unclear how the US threat of sanctions in the event of a conflict could impact supplies. However, the International Energy Agency did also note that OPEC producers are not keeping up with their production targets, and it was possible for them to bring calm to oil markets if they use their still significant spare oil capacity to raise output. What could be holding them back, of course, is IEA's own forecasts of surplus supply in Q2 if output does indeed continue to grow at a steady pace. Now, in terms of the path from here, we reach for a geopolitical playbook. Recall that tensions can often have just a temporary impact on oil prices, which is part of what we're most probably seeing play out at the moment. What is key, though, is whether any fears of supply disruptions from Russia prove temporary or permanent. A scenario where this remains temporary would mean that expected path of higher than lower oil prices would remain valid. From a technical standpoint, though, oil's break above the 200-week moving average is keeping the short-term uptrend very much intact. Now, it's a very busy week ahead, and other than oil, there are three things we'd focus on. The first is the ongoing Fed policy debate. Bullard, who favored a rapid pace of rate hikes, speaks again later today. However, we also have three other Fed policymakers, including Vice Chair Brainard, also set to speak later this week, mainly over Thursday and Friday, and the Fed is also set to release the minutes from its last meeting on Tuesday. Together, we believe these will be key to gauging if markets are being too aggressive in pricing in over 6 rate hikes now over the next 12 months. The second thing to watch is whether US equity market technicals confirm their recent turn lower. The S&P 500 once again dipped below the 200-day moving average, while the Nasdaq broke its pattern of higher highs, higher lows. Having said that, Chinese equities are showing a slightly more positive technical picture, though we'd caution they've not yet broken above a fairly significant resistance level. So two interesting points, technical points to watch on the equity market front. And finally, the market is likely to stay focused on inflation trends with the release of consumer prices in China and the UK and producer prices in the US. So that's quite a bit to focus on, but we'll leave it there for now. Again, if you enjoyed this podcast, please don't forget to rate and like it. Thanks again for listening, and we wish you a happy trading week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.